Thank you so much for joining us today.
Great pleasure.
Now, we're going to speak about something very interesting. It's all got to do with the markets and the fact that the more things change, the more they stay the same. So you can take us back 7 years and talk us through how things have changed dramatically, but really are quite similar.
Yes, well, the thing about markets is that, we see the same things repeat themselves over and over again. And that's got a lot to do with cycles and what we believe businesses are worth at any one point in time. Now, what's different about today versus the point in time before the markets collapsed sort of globally and locally in 2007, 2008, what's different is that different businesses are expensive and different businesses are cheap. What's the same is that there are big pockets of opportunity in the market where the businesses are trading at very low prices, and pockets of great risk where businesses, which may be great businesses, are simply trading at too high a price.
Now, I think that when we discuss the similarities we're experiencing in the market now to what we were experiencing in 2007 post-crash, the next logical thing on people's minds is going to be, does that mean that we are heading for a next big crash?
Well, it's always difficult to say what the market's going to do. I mean, that's the reality, is that what you're trying to do is guess the future, and nobody knows what's going to happen in the future. And in investing, unfortunately, you are investing for the future. What we tend to do is sort of look at what's kind of feasible. If you look at a business, how should it trade? What are normal kind of business conditions for it through cycles? So not at its best times or at its worst time, but sort of on average. And if the price is reflecting the fact that the market is thinking that it will never ever go back to something more normal, then that's an opportunity. In other words, the price is trading well below what that business is worth. On the other side, though, businesses that are very expensive obviously represent a lot of risk. Now, you don't know what's going to happen, but if you consistently avoid those businesses that are very overpriced and invest in those businesses that are cheap, you're going to get good investment returns throughout market cycles, irrespective of what actually happens in the markets at any one point in time. The tricky bit is that the businesses that are cheap, which are very low share prices, are typically the businesses going through incredibly tough times. The businesses which are expensive and which represent risk, because they're actually just trading at more than what they're worth, because everyone loves them and they're great businesses and they're doing very well, unfortunately, those are the businesses that you feel comfortable owning today. And unfortunately, what happened in the last cycle is that precisely the businesses that everyone wanted to own turned out to be the big losers. And the businesses going through a tough time, which was not going to last forever, were in retrospect the opportunity. Same thing today, but interestingly, opposite sectors that are cheap and expensive versus then.
Give us examples.
So then the big story was about how China was going to continue to consume commodities forever after, and there was this story called the super cycle, the commodity super cycle. China was growing and you couldn't get enough commodities out of the ground to actually satisfy the demand coming out of that huge country, which was just going to continue on an upward trajectory. So of course, resource businesses, mining companies, were the businesses that were showing spectacular share price performance, and everyone wanted to buy them. And that story, those good times, were going to last forever. Now, unfortunately, that wasn't to be the case, as it seldom is, and the cycle turned. What happened was, miners just produced too much commodities, and at the same time the cycle turned. So the demand for those commodities dropped and there was too much of them around. There was too much supply. So what happened? The share prices plummeted. So as a result, today the mining stocks, which are in the headlines, which have negative news coming out every day, where there's strikes, where there are oil prices collapsing, where there are other commodity prices collapsing, those are the businesses that have got very low prices because of this pessimism, and which as a result represent a spectacular investment opportunity.